Hello, everyone, and welcome to Cal CPA's Disaster Recovery Series, Episode 3. My name is Danielle Grimshaw, and I am a Senior Tax Manager in the State and Local Tax Group at GHJ. In this third episode, we're focusing on immediate financial recovery and funding options available after a major disaster like the 2025 Los Angeles County fires. Navigating unexpected financial burdens can be daunting, but understanding how to access funds quickly and leverage special tax provisions related to retirement plans can provide crucial support. So let's talk about how you might access funds quickly after a disaster. Beyond direct federal aid, your own retirement savings could be a vital resource, often with special, more lenient rules in a federally declared disaster area. This includes penalty-free retirement plan withdrawals and special loan options. Traditionally, withdrawing from a 401k or IRA before age 59 and a half can incur a 10% early distribution tax. However, under the Secure 2.0 Act, if your principal residence was in a federally declared major disaster area, like those affected by the 2025 LA County fires, and you sustained an economic loss, you may qualify for special relief. One area of special relief are penalty-free withdrawals. You may be able to withdraw up to $22,000 from your IRA or other eligible retirement plan without incurring the 10% early distribution tax. This amount can also be included in your income equally over 3 years, easing the immediate tax burden. Importantly, you have the option to repay these distributions to a retirement plan or IRA within 3 years of the distribution, treating it as a tax-free rollover. Another area are increased loan limits. Your retirement plan may allow you to borrow more. Instead of the usual limits, which is typically the lesser of $50,000 or 50% of your vested account balance, eligible individuals might be able to borrow up to the lesser of $100,000 or 100% of their vested account balance. Lastly, another area is delayed repayments for existing loans. If you had an existing retirement plan loan, your plan may permit a delay of up to 1 year for repayments that were due during the incident period of the disaster and up to 180 days afterward. The loan term would then be extended by the length of the suspension, and the balance would be adjusted for any interest accrued during the delay. When considering these retirement plan options, it's crucial to understand a key point regarding loans and repayments. While federal law provides the framework for these beneficial provisions, the decision to offer expanded loan limits and repayment delays ultimately rests with your employer and their specific retirement plan. Plan sponsors are not required to adopt these disaster relief provisions as they are optional. Therefore, to know definitively if these enhanced loan and repayment flexibilities are available to you, you must consult directly with your plan administrator or human resources department to confirm if your specific retirement plan has adopted these measures and understand the proposed terms and conditions that apply to your situation. Another important area is tax-free disaster relief payments. Certain payments you receive from government agencies or charitable organizations for expenses related to a qualified disaster are generally excluded from your taxable income. This includes payments for necessary personal, living, or funeral expenses, or for the repair or rehabilitation of your home and its contents. However, payments for expenses that are compensated by insurance or other reimbursements do not qualify for this tax-free treatment. Also, consider Roth IRA conversions as a strategic tax move during disaster recovery. If your income drops significantly in the year of the disaster due to economic losses, you might find yourself in a lower tax bracket. This could present a strategic opportunity to convert funds from a traditional IRA to a Roth IRA. While a conversion is generally a taxable event, doing so in a lower income year means you would pay less tax on the converted amount. The converted funds would then grow tax-free and could be withdrawn tax-free in retirement, provided certain conditions are met. This move requires careful planning and a thorough understanding of your current and future tax situation. Finally, remember the extended tax filing deadlines and non-income tax considerations we discussed. These extensions for income tax filing and payment are automatic for those in federally declared disaster areas, providing valuable time. Additionally, in some cases, property tax payments could also be deferred. Always verify the specific deadlines and provisions applicable to your area through the official IRS and state tax authority announcements. Effectively managing your financial recovery is a multifaceted process. It involves understanding various avenues for immediate funds, leveraging tax relief provisions, and strategically planning for your long-term financial health. Consulting with a qualified tax advisor is paramount to ensure you maximize all available benefits and navigate the complexities of disaster-related financial decisions. Thank you, and stay tuned for episode 4, our final episode, where we will cover understanding disaster declarations and state-specific relief.